Markets don't move in straight lines. When price goes sideways, it's not randomness or weakness, it's a reflection of psychology. So some participants are taking profits, others are entering late, and buyers and sellers temporarily disagree on value. So that disagreement creates a consolidation, and consolidation are healthy. Without it, trends burn out quickly. The price needs time to reset, to absorb supply, and rebuild balance before it can move again in a sustainable way. It's really, really important. So in this video, I will explain what sideways consolidations really represent, why they're essential for long-term trends, and why exceptions like the sharp V-shaped recovery during the 2025 tariff crisis are exactly that, exceptions. So understanding this helps you fighting the market and start working with it. Remember to subscribe for more insights like these. Let's dive in. What are these basically? What do these sideways consolidation mean? And they translate people's psychology, so feel free to go and rewatch that. But that's how that's what it means, right? And at the basic level, right? Here we are not, we're not rocket scientists. I'm not trying to do anything very complex. I'm not trying to predict, right? I'm just reading what happens, and based on that, I take action accordingly. I modify my risk management. I'm going to modify if I'm in a trade. Depending on what the price does, I'm going to manage the trade accordingly, and there is no prediction, right? We look for clear signals. We look for confirmation. And then we observe what happened and we react, right? And that's it. Sometimes we benefit a little, sometimes we lose a little, and in some rare occasions, these asymmetric opportunities that we expose ourselves to are gonna pay big time, right? They are gonna make most of the performance of the portfolio. And so that's what we do here as well in my analysis. I do that for myself every week. It's just that now I've decided to share that with you and to talk over my thought process, right? So these are the things that I want to see, right? That doesn't mean it's going to happen, but it would be ideal and very healthy for the market to continue. Let me give you a counter example, right? So as you can see here, when the bull market started in 2024, so we had extraction of this like large kind of cup and handle, but this lasted for almost 2 years, right? Since 2022. 1 year, 2 years, we extracted. So that was kind of the go signal. Okay, bull market has started. We can be aggressive again with risk management. The screeners were getting full. We're getting fuller, more opportunities, better trades, and so on, right? So you can see that the price here is making this sideways consolidation, right? We have one here. We had another one there, you see? So the price is making this consolidation, right? And this is healthy. This is what allows the trend to sustain, right? So that's what we want to see, right? We want to see something that's going to oscillate. You see, here's a good example. We had quite a severe drop. It corrected, and then toward the end, you see that the volatility is decreasing, right? We have really a decrease in volatility before the break, and once it clears the level, pullbacks, but stays above, and that's it, right? And like the opposite example is what we had this year, a very sharp drop, right? Like really, really, really sharp drop, and then sharp, basically bounce back in the direction of the trend, like a V, right? This is what we call like a V bottom. And well, usually actually this extended for quite a while, right? And that was quite a smooth trend before we consolidated there. So this can happen. I'm not saying it cannot, but usually when you have a strong bounce and a unilateral move, it cannot be sustained over time, right? You're going to have eventually it's going to snap and correct. So I would say this is like an exception, but you can see how severe that drop was and how severe the recovery was. What we prefer to, this is difficult. If you would see that on a stock, you can't really trade that. It's difficult to it's difficult to expose yourself to that because of the volatility, right? That means that this is uncertain time. There's really no disagreement. Like people basically freaked out, they panicked, they sold, and now they buy back, and it just goes in a straight line. There's no clear level to. I mean, you could enter here, but there's no clear level to necessarily place your stop. This hasn't been consolidating with a reduction in volatility for long enough, so we have something explosive. It might be this actually has a lot of steam, right? So if like me, we are trading breakouts, once it clear key levels, then it means you would enter right there. If that was a stock, right? I don't trade indices, but if that was a stock, you would enter right there. But look at how much momentum has already exhausted, right? That's behind. The move started from all the way down there, pumped all the way up there, then broke, and then you're buying. So you're buying at a very high point on like that trend, right? And that has used up a lot of fuel, a lot of steam. So basically, statistically, the odds are not in your favor. They are against you that this keeps going for a while. And it did here, right? But that is why we want to see things like that. That is why we want to see a correction. So that's a sideways consolidation, correction, drop, recovery, and then a clear level where the price is going to play tennis. There's a tennis match going on there. Volatility is contracting, right? Which basically means like we had a move down, a move up, and then it's pausing. So the next move, should it clear that key level, the next move is going to start from here. So you're going to have potentially a lot of steam behind it. You're starting from the beginning, right? Unlike here, where you're starting from very far away. Anyway, so that's all for consolidation, but that's kind of like how I look at it and how I look at trading.